Welcome back to the deep dive. Today, we're digging into some specific source material.
That's right. We're looking at generating income through, well, what one article calls fat dividends.
Yeah, exactly. The piece is titled Fat Dividends for Your Forever Portfolio. And it says right off the bat, it's skipping the, quote, financial salad.
Right. Getting straight to the main course, the fat dividends.
It does paint a, let's say, memorable picture. Talks about yields that make your portfolio want to wear sweatpants to Thanksgiving dinner.
Okay, I won't forget that visual anytime soon. A bit dramatic, maybe, but it sets a tone.
It does. So the goal for us today, based on this source, is really to unpack what they mean by fat dividends.
And then look at the specific companies they hold up as examples, right?
Exactly. See how they fit this model. So let's dive in. What is the core idea here, according to the article?
Well, fundamentally, it seems to be about getting a high yield right now, today.
Okay, so not about potential growth years down the line.
Not primarily, no. Or, hoping a tiny yield suddenly balloons. It's about substantial income flowing in consistently.
Right. The article really emphasizes reliability. It uses that phrase, they show up every quarter like clockwork.
Yeah, that dependability seems key. It's presented as an alternative to, say, relying on market timing or just reinvesting tiny payouts hoping for magic later.
So it really shifts the focus away from just price gains or even how fast the dividend is growing.
Exactly. It's more about the size of the current yield and, crucially, its perceived safety and consistency.
And the article gives us two main examples of this kind of buy and hold forever income play.
Okay, who's first?
First up is Altria Group, ticker MO.
Ah, Altria. And the article has a nickname for it, doesn't it?
It does. Calls it, rather bluntly, the sin stock that pays for your sins.
Well, that certainly gets your attention. Okay, so what are the stats the article highlights for MO?
It points to a current yield, around 8.6%.
Wow, okay, that's definitely a high yield.
And it backs that up with a really long dividend growth streak, 54 years, according to this source.
54 years.
Yeah.
That's quite a track record.
Uh-huh. It also mentions the payout ratio is around 75% of earnings. And it's in the consumer defensive sector, specifically tobacco, obviously.
Right. So what's the article's actual case for Altria? They call it the cash cow king, I think.
Yeah, that's the term. The argument hinges on, the addictive nature of cigarettes.
Oh.
This gives the company supposedly strong pricing power, so even as smoking volumes might slowly decline.
They can just raise prices to compensate, keeping the revenue slowing? Is that the idea?
That seems to be the core argument, yes, to maintain that cash flow.
And they also mentioned something about it being recession resistant.
They did. A bit cynical, perhaps, but the article suggests people might even smoke more when stressed during economic downturns.
Huh. An interesting, if maybe grim, angle on defensive.
It is. The article also talks up Altria's commitment to shareholders, stellar shareholder returns, they call it.
Meaning the high dividend payout.
Right. That stated goal of returning over 75% of earnings as dividends, they present it as a serious commitment, not just talk.
Okay. And did they mention diversification? I know Altria has been trying other things.
They did touch on that. The diversified sins angle mentions the 10% stake in Anheuser-Busch InBev, the beer giant.
Right.
And the push into newer areas like nicotine pouches, Zyn gets a mention, and maybe cannabis down the road.
So acknowledging it's not just cigarettes anymore, but the core engine is still that traditional business.
That seems to be the implication. Now, the article's forever thesis for Altria, it's important to note it's not about growth.
Okay, so what is it about that?
Purely about that consistent high income payment, that 8.6% yield paid regularly.
Got it.
They argue things like share buybacks and those price increases help keep their earnings per share, or EPS steady enough, even if overall cigarette volumes fall a bit.
So managing the decline while maximizing payouts.
Pretty much. The article's blunt take. The market exists, quote, as long as people have stress and lungs.
Wow, that's stark.
It is. So the summary is, yeah, it's controversial, maybe boring in its business operations day to day, but it's legal, and it's been paying out that income for a very long time.
So presented as a cash distribution machine, essentially. Less about reinvesting for future expansion.
That's the picture painted, yes. Okay, let's move to the second example. Enterprise Products Partners, ticker EPD.
Okay, EPD. And does this one get a flashy nickname, too?
It does indeed. The pipeline that prints money.
Huh. Okay, another vivid one. So EPD stats, what does the article highlight?
Current yield listed around 7.3%, so still quite high,
Uh-huh. Still a fat dividend by most standards.
and a distribution growth streak of 25 years. Now, structurally, it's different. It's a master limited partnership, an MLP.
Right, MLPs, often found in the energy infrastructure space. Midstream energy, moving oil and gas around.
Exactly. Not the drilling, but the transport and storage. And they highlight a solid distribution coverage ratio, about 1.8x.
Okay, 1.8x coverage. That suggests the payout is pretty well supported by the cash flow, with room to spare.
That's how the article presents it. Now, their case for EPD, it really focuses on fee-based revenue.
Meaning they get paid for volume, not necessarily the price of the oil or gas itself.
Largely, yes. The article says over 85% of revenue is fee-based, so less direct exposure to those wild swings in commodity prices. The quote was, "Volatility is for suckers."
Makes sense for an income-focused thesis. Predictability.
Right. They also describe EPD as built like a tank.
How so? Infrastructure.
Yeah, detailing the sheer scale. Over 50,000 miles of pipelines, massive storage capacity for natural gas and liquids, billions of cubic feet, hundreds of millions of barrels.
So huge, hard-to-replicate network of assets.
That's the idea. Something else highlighted is insider ownership.
Oh, who owns it?
The Duncan family apparently owns over 30% of the partnership.
Okay, significant. The article probably frames that as a skin in the game, right? Aligning management with long-term unit holders.
Obviously, aligning interests towards stability and distributions.
And you mentioned the MLP structure. Taxes are different there, aren't they?
They are. The article touches on the tax advantages. As an MLP, EPD itself generally doesn't pay corporate income tax.
And for the investor, you get a K-1 form instead of a 1099, which can be, well, more complex at tax time.
Right. The article acknowledges it might annoy your tax preparer, but argues it saves you money. Often, distributions are treated as a return of capital, deferring taxes until you sell.
Okay, so a potential tax benefit, but with added complexity. Good to know.
So putting it all together, the article's forever thesis for EPD casts it as the toll booth of energy.
I like that analogy. Essential infrastructure.
Yeah, maybe boring, but critical. Run like a long-term family business underlined by that 25-year streak of raising distributions.
And that 1.8x coverage ratio comes back in here, suggesting safety.
Exactly. Safety for the current payout and maybe potential for continued gradual increases. Not necessarily, doubling the payout overnight, but steady growth.
So again, the focus is squarely on fat, dependable income.
That's the phrase they use. Now, the article kind of anticipates a question here. Aren't these stocks just, boring?
Yeah, I can see people thinking that. Tobacco, pipelines,
Yeah.
not exactly thrilling tech stories.
And the article leans right in. It calls them painfully, delightfully, irresistibly boring.
Okay, so boring is a feature, not a bug in this view.
That's precisely the argument. For income investing, the article claims boring is the new sexy.
Because boring implies reliability, predictability.
Exactly. You want investments that just quietly, consistently churn out cash. They have another great line. You want your money working quietly, like a librarian with a side hustle.
Okay, that's pretty good. I like that one too.
And to really drive this point home, the article does a sort of side-by-side comparison, arguing why these fat dividend stocks, in its view, beat the pants off flashy tech fads in the long run.
The contrast. What metrics do they compare?
Things like dividend yield, 7-9% for these versus maybe 0-1% for a lot of growth tech.
Big difference there.
Recession resilience, they label these strong versus tech, maybe crying in the corner. A bit dramatic, but
Makes the point.
payout history decades versus maybe we promise to reinvest it all someday.
Right. The classic growth stock line.
Management alignment, insider ownership versus, quote, we sell stock at every peak.
Ouch. Okay.
And finally, investor stress level, minimal versus maximal.
That's an interesting one to include. The emotional side of investing.
Yeah, it really highlights that fundamental difference in what you're trying to achieve. If income and stability are the goals, the metrics you value change.
It's a very clear argument for a specific investment style tailored to a specific goal.
Definitely. Now, they use the phrase buy and hold forever, but then they add, importantly, the fine print.
Always read the fine print. So forever doesn't literally mean forever.
Not quite until the heat death of the universe, no. The article clarifies it means until the reason you bought the stock no longer exists.
Okay, that's a much more practical definition. So how do you know if the reason still exists?
They give you 3 basic questions to ask yourself periodically. 1, is the dividend still safe?
Crucial for this strategy.
2, is the company still doing what it's supposed to? Is the pipeline company still piping, the tobacco company still selling?
Right, is the core thesis intact?
And 3, are you still getting paid? The article puts it colorfully, like a landlord in a boomtown.
Heh. Okay, so if the answers are yes, yes, and yes,
Then according to the source, you hold. And, just as importantly, you tune out the market noise.
ignore the headlines about the next big thing, the daily ups and downs.
That's the advice. Focus on collecting that income stream. Don't get distracted by hype or fear.
Which brings us back, I suppose, to how this connects to you, the listener,
Yeah.
wanting to get up to speed on this particular perspective.
Right. The core idea being presented in this source material is really about making money while you sleep. They even reference that famous Warren Buffett quote.
And this article's specific angle is that these maybe unglamorous, definitely not trendy stocks are a prime way to do that.
Yeah, they're very upfront. These aren't stocks for, chasing 10x returns in a week or getting excitement fix.
But they hammer home what they are supposedly designed for.
Yeah.
The article literally says, pay you forever.
Strong words.
And it concludes with this interesting thought, contrasting volatile gains with steady income, saying, a big gain can disappear in a flash.
Right. Market swings.
But a steady check. The article calls that the heartbeat of your portfolio.
A powerful metaphor for reliability. So wrapping up our deep dive into this specific source on fat dividends.
The central argument we've unpacked is really about the value proposition of reliable, maybe even boring, high-income streams from established companies.
Yeah, the article makes a pretty focused case for prioritizing that steady, predictable cash flow over chasing potentially higher but much more volatile growth or market appreciation, especially if income is your main goal.
Which leaves a final thought maybe for you listening. Based on this source's perspective, what resonates more?
Are you drawn more to that potential but uncertain upside, the maybe flashier investments, the kale of the financial world, as the article puts it?
Or does the idea of a dependable, consistent income stream from these established, perhaps boring companies, the bacon in their analogy, feel like a better fit for your own financial journey and risk tolerance? Something to chew on?